Hey everyone, welcome back to All Things Home Loans, Credit, and Real Estate. I am your host, Deb, the Mortgage Queen. So let's start learning. Hey, Mortgage Queen here today. We're going to talk about private mortgage insurance and mortgage insurance premiums. They're basically the same thing. They have different purposes in regards to which loan program they're with, but at the end of the day, they're insurance that allows us to get a little bit higher loan amount, a little bit less down payment. Let's talk about this. It's probably, I would dare say, has probably the worst reputation in the market. Nobody wants to pay it, including me. Like, I guess I could sit here and say I'm a little bit hypocritical of like, hey, it's a really good thing for us to have mortgage insurance because you don't have to have a 20% down payment, and I will do everything in my power to not have to have mortgage insurance. I personally have never had to pay it, thank goodness, because we've always been blessed to be able to have a 20% down payment. My children have had to pay mortgage insurance because they haven't had that kind of a down payment, but I can't even say it's a necessary evil because it's evil, but it's necessary unless we all want to save up for 20% down. So let's talk about a little bit about it and what it really is. It's not a penalty. When it came out, it was put out so that it would incentivize investors to lend money at a higher loan to value, so people wouldn't have to have such a large down payment. And it allowed them to say, hey, if by chance this person does not perform on this loan, we, as an insurance company, are going to step in and help you recover some of your loss, lender. So let them have a little bit more of a loan, and we'll help you in the event that they don't perform. But in a roundabout way, people think they're penalized for having to pay it. And that's just like every other insurance. You have to pay car insurance, you have to pay health insurance, you have to pay your insurance for your home. There's just insurances everywhere you turn around. This is just one of those things that it protects the investor. You gotta think, they already gave you all the money. So here's your $300,000 to buy this house. Hopefully we get it back. But if you don't give it back to us, what do they have? Yes, they have the house, but what if they lent 100% financing? By the time they go through the court fees and all of that, they're upside down. Yes, we could have the argument that they've made a lot of interest off other people's loans, but you can't do that. You got to keep your loan in your own little scenario there. But just keep in mind, it's not a penalty. There's definitely communication about that a lot, that mortgage insurance is a penalty. I feel like this mic is in a really weird spot. So anyways, now I'm done touching it. I'm not going to touch it. Then, man, I wish I would have looked it up because I don't remember when it was, but we're going to talk about the difference between conventional mortgage insurance, FHA mortgage insurance, USDA mortgage insurance, and the lack of mortgage insurance on VA, because those are really the four entities that have anything to do with mortgage insurance. Let's start with conventional. Conventional loans will require mortgage insurance unless you have a 20% down payment on a purchase or a 20% equity position on a refinance. And you don't get to utilize the equity that doesn't belong to you. So on a purchase, if you're buying a house for $300,000 and you're putting $60,000 down, you don't have mortgage insurance because you have a 20% down payment. But say that same scenario, I'm buying a $300,000 house and it's worth $350,000 and you're putting $40,000 down. You have equity there that would be a 20% equity position, but that is not yours until you own the home. Therefore, you can't use the equity in the home unless you own the home. Kind of like a little catch-22. So yeah, conventional is the mortgage insurance that falls off. So once you hit your 20% position based off the purchase price, that's what it goes off of from when you acquired it, 20% equity position off the purchase price, or 20% off the appraised value if it's a refinance, you can call and actually request the mortgage insurance to come off. They won't just take it off at 80%. In most cases, they'll require it to sit there for another 2% till it gets to 78%, and then they're required to take it off. But if you pay attention, and once you get to that value position of 80%, 80% of the value of the home or purchase price in our scenario, then you can just call the servicer and say, hey, I've met my obligation. My original purchase price was this. My principal balance is this. Therefore, my mortgage insurance can come off. Now, I do know that there are some mortgage insurance companies that require you to have mortgage insurance for at least 1 year. So say you bought a home for a $300,000 purchase price, put a 5% down payment, so you're at 95% of the value of the home / purchase price. and then you end up selling some land or getting an inheritance or making a bunch of money off something, and you're able to dump a huge amount of money into your mortgage 6 months into the deal, call the servicing company and say, hey, I want that mortgage insurance removed. Some mortgage insurance companies require it for a year, so you may not be able to do that. It would be worth asking your servicing company before you dump a bunch of money towards it, if they allow that mortgage insurance to come off faster than 1 year. Because if not, throw that money into a high interest bearing account for 6 months or 8 months or whatever it is, make a little bit of money off of your money, and then your mortgage insurance can come off when you've hit that year mark or whatever it is. So communicate with the servicing department. Um, the the frustration that we have with conventional is mortgage insurance nickel and dimes every tier on your credit and your debt ratio and everything. So your credit score is at a certain spot, your mortgage insurance premium is going to be a certain amount. If your debt ratio is up a certain level. So if you have like a 49% debt ratio and a 720 credit score, your mortgage insurance is going to be more expensive than somebody who has a 760 credit score and a 44% debt to income ratio. It's just that simple. The risk factor of a higher debt ratio, the risk factor of a lower credit score, that's going to be an adjustment to that mortgage insurance. And it's like a risk. Like, hey, if you're at 49% of your income is going towards your debt and your credit score is barely a 700, sure, we'll give you a loan on a conventional side, but you're going to pay a little bit higher premium. It kind of compares to car insurance. If you have a whole bunch of speeding tickets, if you have a couple accidents, home insurance that have water claims, any of those kind of things, you're going to pay a higher insurance premium because you're more of a risk. It's the exact same logic. All insurance follows the same logic. If you're more risky, you're more your cost of your insurance goes up. Let's talk about FHA. FHA, and I know I've said this before, I want to know how much money sits in FHA's bank account, Federal Housing Administration. Back in, I want to say it was 2013. Don't quote me on that, but I want to say it was back in 2013. FHA rolled out and said, we don't really care how much your equity position is. You're going to have mortgage insurance for the life of the loan if you take maximum financing. If you put at least 10% down, your mortgage insurance is going to go away in 11 years. Okay, so I do a 96.5% first mortgage. I pay on it and I get a huge lump sum of money that I want to dump towards it 3 years. Maybe a parent died and I have this huge lump sum chunk of money. I'm going to dump it towards my mortgage. Doesn't matter if you're a 20% equity position. FHA keeps that mortgage insurance for the life of the loan. Now it's on a tiered basis. So the percentage of mortgage insurance is based off of how much you owe on the mortgage. So as that goes down, so does the percentage. So I owe $100,000 on my house. My mortgage insurance factor is 0.55. Then I owe 99. My mortgage insurance is 0.55. Basically that 0.55 is multiplied against what that loan amount is, and it's divided over 12. So you've got a small, teeny tiny amount of decrease that comes off that mortgage insurance every year. Eventually, it's a very minimal number. This is an interesting comparison though, and I'm going to use a like program. In Idaho, we have Idaho Housing. They have an incredible program. They are just a really good advocate for homeownership, and I just love them. But when the market closed on Friday, the interest rate on a conventional first time, not necessarily a first time home buyer program, but a purchase program was at 6.125. The interest rate on FHA was 5.75. So the interest rate usually is cheaper on FHA than it is conventional. And when you look at when mortgage insurance is going to come off in comparison to a lower rate, and you start looking at it, a lot of times it's a wash. So I take 6.125 on a conventional mortgage insurance type loan, and over the life of the time that I'm going to have mortgage insurance until I get my 20% equity position, or I compare it to a 5.75 rate that FHA mortgage insurance is there for the life of the loan. If you really line up your amortization schedules, they're actually really close to the same amount of money. They're very, very, very close. And sometimes even FHA's monthly payment is a little bit lower too, because like I said on conventional, when conventional interest rates are a little bit higher and you have a 49% debt to income ratio and a 720 credit score, mortgage insurance might be higher on conventional than it is on FHA. Plus, FHA has the ability to have a little bit lower interest rate because of the life of the loan interest, mortgage insurance premium that's there. So it's really an educational thing of like, all right, if you're starting to tick up there a little bit on the debt ratio and your credit score is a little bit lower, we definitely want to look at both sides of the equation and make sure that we're putting you into the right loan. Now, obviously, there are some cases that it's just better to go FHA. It's just straight up better. I've had just recently, I had a 727 credit score. Debt ratio was really good, but for whatever reason, I could not get mortgage insurance to get any cheaper than about 1.01. Okay, so the factor of basically 1% of my loan amount divided by 12 was going to be what my mortgage insurance premium was on my conventional loan. Well, it's 0.55 on FHA. It's like almost half. So it was just cheaper straight across the board for us to do the FHA loan, which we did. We ended up doing that. I ran the numbers a couple of times just to make sure I didn't have something in there wrong, but whatever the situation was with that, I could not get that mortgage insurance to be prettier. The thing about FHA though is it's got two levels of a mortgage insurance premium per se. The monthly that you pay on a monthly basis, and then at the time of closing, you're actually paying a lump sum amount of 1.75 of your loan amount. So 1.75% fee against your loan amount gets added to what we can borrow, and that is above and beyond what you're paying on monthly. So FHA also has two mortgage insurance premiums, and the hard thing for people to understand is, well, I paid this lump sum up front, and why am I paying it monthly too? That's just what FHA does. It's like your down payment, I guess, on your mortgage insurance. But the nice thing about that part of it is, in the event that you're tight on money for cash to close, it gives you the ability to finance it in. So you are just able to obtain a higher loan amount to be able to finance that dollar amount in. Okay, so let's jump to USDA. USDA years and years ago added what do they even call it? I can't remember what they call it. Some sort of it's a guarantee fee on top of a monthly fee that they charge as well. And that mimics FHA. It doesn't go away. It's there for the life of the loan, but it's also a very small factor. It's 0.35. And so as your principal balance goes down, the factor of 0.35 is what goes against that loan amount for your monthly payment. The rural development was, I think, in kind of some financial situations that they had to throw a little bit of help to themselves, because 100% financing in USDA has just always been what they do. Obviously, USDA is catered to a lot stricter debt to income ratio now, and they're also restricted to certain areas outside of the city limits. And the mortgage insurance that they charge is very reasonable, but still there to protect them. The nice thing about VA is VA only has one fee that is more than likely not going to be charged to any veteran that's receiving at least a 10% disability. The VA loan is set aside for veterans only, or surviving spouses of veterans that passed away due to service-related deaths. They don't have a monthly mortgage insurance. VA does not have a monthly mortgage insurance, but they do have an upfront funding fee that they charge, and that's based off of how many times you've used it. If you're receiving any type of disability benefits, that also will dictate whether or not you've got that funding fee. Every loan we've got has some sort of protection in regard to higher loan to values, and I think it's a good thing, because if you look back in like the 1970s and 80s, you had to have a 20% down payment to be able to even buy a home. And I know there's probably people listening to this like, oh, 20% of $25,000 was really low. No, it really was still high back then. You can't compare the dollar today to what the dollar was in 1985 and think, oh, a $25,000 house is $300,000 now, right? But just look at the dollar. I have a soapbox. I need my soapbox for that particular conversation. But what is kind of another misunderstanding is you talk about appraisals. I buy a house and it doesn't have a finished basement. Fast forward a year and my basement is finished and I end up with a killer awesome interest rate, so I don't want to refinance. I've taken my money out of my extra money I've got every month and I've just dumped it into getting my basement finished. So of course I probably have some sort of equity. I reach out to the servicing department at the place that I'm making my mortgage payment and say, hey, I finished my basement. I think I've got some equity. How do I find out what my house is worth so that maybe we can get rid of this mortgage insurance? Number one, they send out the appraiser. You don't get to choose who the appraiser is. They have their people that they send out, so you can't sway the appraiser and tell them where you need to be value-wise. And then also, they have the right when they receive that appraisal to not remove your mortgage insurance. If they're concerned about at all, they still have the right to not remove that mortgage insurance. You signed the contract saying that mortgage insurance was going to be there for a certain period of time. And they do reserve the right to not have that mortgage insurance be removed. So keep that in mind when you go to the expense of having a new appraisal done. And it's also good to do a little bit of due diligence. Call the realtor that helped you buy your house and say, hey, I finished my basement. What is this thing going to be even worth? And say you bought it for $300,000 and you would need it to come in at $350,000 to get rid of your mortgage insurance. And they're like, well, we've got comparables, but nothing more than $310,000 to $320,000. Then maybe it's just not worth doing the appraisal. It's definitely something to do some homework on. The interesting thing about mortgage insurance is how much it's changed over the last many years. There was a window of time, this is so crazy, to even think about, is there was a moment in time that I could have a 760 credit score, beautiful debt to income ratio, and somebody with a 680 credit score, beautiful debt to income ratio, would have a cheaper mortgage insurance than me at a higher credit score. And the reason why is because the logic behind that was, hey, new homeowners, new first-time home buyers, most of them don't have low credit scores because they don't know how to pay their credit or anything. It's because they just don't have a lot of credit depth, and you can only get so many credits. Your score can only go up so high so fast without certain lines of credit reporting. And so they were trying to give these new first-time home buyers a break, which was really sad because it should just be higher credit scores get just as good as the first-time home buyer at a 680 score and compared to 760. Oh, yeah, that was a super frustrating situation, a super frustrating time. You look up the statistics of whether or not that gained anything. Oh, I don't know, but it sure was frustrating when it was going on. But the mortgage insurance on a 15-year, if you end up doing a 15-year mortgage and you still don't have a 20% equity position, that's going to be a lower insurance premium. Same with a 20-year. There's different charts if you're 30, 20, and 15, and that's going to be a lower insurance premium as well. The one thing that I would just as I kind of close this down, I just want to stress the point of mortgage insurance is necessary, or we wouldn't have the homeownership opportunities that we have right now. If you sat in a room with 20 people who were all homeowners and you said, hey, how many of you in this room were able to put a 20% down payment on a house? More than likely, nobody would raise their hand. Nobody. I very rarely have anybody have that kind of money. Sometimes you have people who get gifts from parents. Sometimes you have people who bought at the right time. They were able to sell their home and be able to get into a new home and roll their money from one house to the other. But you back up the first house and they didn't have a 20% down payment there. So it's very important to not be discouraged if you don't have a down payment. It's really, really good to not be discouraged if you have to pay mortgage insurance because it's there for a reason. And it gives us the opportunity to get into homeownership without having a 20% down payment. So I caution you with having a very disgusting attitude about mortgage insurance because we are able to become homeowners without a 20% down payment because of it. Now, if we could get into the pockets of the mortgage insurance companies and how much money FHA has, that'd be really cool to know. I actually Googled it a couple of months ago just for my kicks and thrills of my rabbit holes that every once in a while I go down. I got so many different answers. I don't know which the truth is, but I definitely think they probably, like most insurance companies, have more insurance money sitting aside than they've actually paid out. But with that being said, be grateful for mortgage insurance. Be grateful that we don't have to have 20% down payment because a lot of us would not be homeowners without that. And yeah, the Mortgage Queen here talking about mortgage insurance, private mortgage insurance premiums. And I'm just super excited to be able to teach you these topics. And if you like what you hear, go ahead and hit the subscribe button. Definitely share this with your friends who are looking at homeownership so that they can just explore this channel and learn everything that they need to learn. So till next time, Mortgage Queen's out. Thanks so much for listening. I really appreciate it. So stay tuned. We are going to learn some more next time.